as part of stage 3, where we have to do the projected cash flow projected cash flow, we need also to understand as to what is that we need for finding out the projected cash flow. So for finding out projected cash flow, number one, what we need to find out the gross profit. And how do we find out the gross profit? We will find out the gross profit by deducting from the revenue the cost of goods sold. Cost of goods sold. And so when we deduct the cost of goods sold, which is nothing but, in case of a five-star hotel, it is going to be the cost of material, and it is also going to be the cost of delivery of those services, cost of material and cost of services, and the cost of delivery of those services. So that is what is going to be the COGS in this case. So when we add the material cost and the cost of delivery of that service to the customer from the revenue that the hotel will get, that is what is referred as gross profit, and that is what we will need to find out for doing the valuation of this hotel property using the discounted cash flow. We will also need to find out the EBITDA. EBITDA is earning before interest, tax, depreciation and amortization. So how do we find out EBITDA? For finding out EBITDA, what we need to do, we need to deduct from the gross profit something which is known as SG&A, selling, general and administrative expenses. We need to deduct from the gross profit. So when we deduct the SG&A, selling, general and administrative expenses, from the gross profit, we get something which is known as EBITDA. EBITDA is earning before interest, tax, depreciation and amortization. EBITDA is also known as cash operating profit, COP. Then we also need to find out EBIT. And how do we find out EBIT? EBIT is EBITDA minus the depreciation and amortization. So when we deduct depreciation and amortization from the amount of EBITDA, what we get in our hand is known as EBIT. Then we need to find out the EBT. How do we find out the EBT? So EBIT minus the interest cost or the finance cost or the borrowing cost, they all mean the same thing. So when we deduct interest cost, finance cost and the borrowing cost from the figure of EBIT, what we get is EBT, earning before tax. And then we need to find out EAT. And how do we find out EAT? EAT is earning after tax. From the EBT, we deduct the taxes. And remember which taxes? Corporate tax. That means income tax levied on a company, corporate tax. And so we deduct the taxes from the EBT, and what we get is EAT. So remember, EAT is important for us, but other than EAT, what is also important is something which is known as cash accrual. Cash accrual. And how do we calculate cash accrual? Cash accrual is EAT plus depreciation plus amortization, and all of them put together is known as cash accrual. Cash accrual, that means this is the amount of cash which is coming in the hands of the company from the P&L. From the P&L. Please remember, as I mentioned earlier, for the purpose of discounted cash flow method, what you need, what is the prime basis? Prime basis is the cash. Remember, cash is the value. जिस business के पास में cash, the business does not have a cash, it does not have a value. So that is the number one thing that you need to find out, that is cash accrual, and that is your EAT plus depreciation plus amortization. This is the cash accrual. So remember, in a business, not only you get cash from the profit and from the operations, but you also get cash from the changes in working capital. So what does it mean? It means that if your current assets today are 100 crore, and if the management works very hard and they are able to bring it down to 50 crore, so that means you have a cash free, becoming free from your current assets, and this is also going to be part of your free cash flow that I mentioned earlier. So for the purpose of projected cash flow, number one, we need to find out all these things that I mentioned to you: gross profit, EBITDA, EBIT, EBT, EAT, and cash accrual. We also need to make adjustment with regard to changes in net working capital. So if your net working capital is increasing, and what is net working capital? NWC, net working capital is current assets minus current liabilities. So that is your current assets minus current liabilities is your net working capital. So if your net working capital is increasing, that means you are eating cash. If your net working capital is decreasing, that means you are freeing cash, and that freeing cash is going to increase value of your business because so much extra cash is going to be available in the hands of the business. And we also need to make adjustment for addition and deletion in the capex. Obviously, if there is an addition of capex, that means so much of cash is going to be eaten away. Remember, the cash may be eaten away today, so therefore it is going to be outflow. But when you create an asset using cash today, now that asset which you are creating is going to generate more cash for you in the futures to come. And that means today when you add an asset, it eats the value of your business because so much of cash has gone out. But this same asset which today has eaten your cash for all the times to come in future, this asset is going to generate more cash for you. And that means in future, this cash which is eaten away today by way of capex is going to generate more cash for all times to come. And that is the addition that we have to make. Of course, we also have to make adjustment for raising of fresh equity capital. So in case if the business has got more equity infusion happening, that means so much of extra cash is going to be available, and that means it is going to increase the value of that business to that extent. And likewise, in case of debt also, so when in case of the company is borrowing, that means company's cash is increasing, and that means to that extent the value of business is going to increase. Not only that, the loan that you are taking that loan for the purpose of fresh investment. So those investments in future are again going to generate more cash for you, and that is how these adjustments are going to impact your cash flow and thereby your valuation. So this is part of the stage 3, that is estimating projected free cash flow. Now, before I move to the sub part of this stage 3, I would throw it open to everyone. In case if there is any question, any doubt, you can please ask me. And after that, we will go to the next part of stage 3, and then we will move to stage 4.